Hello and welcome to Quant Matters, where we talk about the quantitative approach to investing and finance. Today we're going to look at the Sharpe ratio as a way to evaluate investments. By the end, you should have an intuitive understanding of what it measures, along with the specifics you need to calculate it for your own portfolio or to rank assets accordingly. Before we start, I want to mention that the channel now has a Patreon page. There you can download the finished code for a historical pricing dashboard we built in a past episode, along with an expanding PDF that collects the material covered on the channel. It's designed as a reference, especially if you prefer reading or want something to revisit later. Structured quantitative investing relies heavily on measuring risk and reward. We've already discussed these ideas when we arranged investable assets by risk, reward, and time horizon, and talked about the inverse relationship between risk and reward. We also covered alpha, which measures comparative reward, a more focused way of evaluating returns relative to a benchmark. And we discussed volatility and drawdowns, which you can think of as measuring how unstable or how stressful an investment has been historically. Sharpe brings these elements together by telling you how much return you earn relative to the volatility you had to endure to get it. Because of that, it has become a widely used metric. To compute Sharpe, you need three things. First, you need the average return of the asset. This represents the reward it has generated over time and serves as an estimate of its expected return. Second, you need a risk-free rate. This acts as a baseline, the return you could have earned without taking meaningful risk, typically proxied by a short-term government interest rate. And third, you need a measure of how much those returns fluctuate, in other words, the asset's volatility. Sharpe then relates the excess return, what you earn above that baseline, to the volatility you experience while earning it. This is the formula for Sharpe, which might look a little scary, but it is just the previous elements we discussed. So mathematically, Sharpe is simply the expected return minus the risk-free rate divided by volatility. We will be updating the spreadsheet we made comparing various assets in the risk episode to include Sharpe, as most of the information needed is already there. As a reminder, we had a small diverse basket of assets: SPY for stocks, IEF for bonds, GLD for commodities, and BTC/USD for crypto, with daily prices sourced from Google for the full year in 2025. Here's the summary table as a starting point. The first step is to find a number for the risk-free rate of return. For this example, let's go with 4%, which is a rounded average of short-term US Treasury bonds during 2025. After that, we can simply subtract the risk-free rate from the expected return and divide that by volatility. Make sure you are using annualized numbers, else you will get nonsensical numbers. Here's the final table we Sharpe for 2025. Now that we've calculated the Sharpe ratios, the next question is, how do we interpret them? As a rough rule of thumb, a Sharpe ratio around 0 means you are not being compensated for risk relative to the risk-free rate. Around 0.5 to 1 is generally considered reasonable. Above 1 is strong. Above 2 is exceptional. A negative Sharpe means the asset underperformed the risk-free rate over the period measured. Returning to our table, we can now add context to the numbers. SPY at 0.70 is broadly in line with what you might expect from equities in a solid year. Meaningful return paired with meaningful volatility. IEF sits close to 0, which makes sense. Its return was only marginally above the risk-free rate, so once volatility is accounted for, very little excess compensation remains. GLD at 2.36 clearly stands out. During this period, gold delivered unusually strong returns relative to the volatility investors experience. Bitcoin, with a slightly negative Sharpe, tells the opposite story. Over this window, investors were not compensated for the volatility they endured. Returns simply didn't justify the instability. And that's the main point. Sharpe doesn't tell us which asset is best or better. It tells us which asset was most efficient at converting risk into return during this specific period. Sharpe ratios aren't just for individual assets. In practice, they are most often used to evaluate portfolios and investment funds. The exact same formula applies, but instead of plugging in the returns of a single asset, you use the returns of the entire portfolio or fund. Sharpe then measures how efficiently a combination of assets converts risk into return. For instance, two volatile assets, when combined, can sometimes produce a higher Sharpe ratio than either one individually, because what matters isn't just volatility, but how returns move together. That's why fund managers, hedge funds, and quantitative strategies are almost always evaluated on the portfolio Sharpe, not the Sharpe of their individual holding. Let's quickly recap. The Sharpe ratio gives us a single number that relates excess return to volatility. It tells us whether the returns we're seeing are worth the risk being taken. We've seen how to compute it, how to interpret it, and how dramatically it can differ across assets depending on the market regime. And importantly, it applies not just to individual assets, but to portfolios and full strategies. In a future episode, I'll be adding Sharpe and other risk-adjusted metrics directly into the dashboard so we can evaluate strategies in real time. Thanks for watching, and if you want more quantitative content, please consider liking and subscribing to Quant Matters.